Hey everyone, and welcome to this High Yield Explainer. If you're an accounting student or frankly just anyone looking to gain some real-world financial literacy, you are absolutely in the right place today. We're going to build a rock-solid study guide together because, mastering these financial reports isn't just about passing your next exam. It's literally the foundation for understanding how any business actually operates out there in the real world. There's this really famous saying in business that goes, a person who cannot read financial statements is like a driver who ignores the dashboard. They may keep moving, but won't know when they run out of fuel. And I just love that. It hits the nail right on the head. This whole explainer is all about learning how to read those crucial dials on a business's dashboard, because without them, well, you're pretty much flying blind. Now, to make sure we're working with the absolute best, most rigorous info, we're pulling our framework today straight from the Faculty of Accounting and Auditing at the University of Economics and Law. Specifically, we'll be looking at the standards set by VAS 21 and Circular 99/2025. It's highly authoritative, it's structured, and we are going to completely demystify it for you right now. Okay, so here's our roadmap. We'll hit financial dashboard essentials, look at the snapshot versus video concept, unravel the profit-cash paradox, learn to follow the cash flow, and wrap up with reading the fine print. Let's jump right in. Starting off with Section 1, Financial Dashboard Essentials, looking at the 4 core reports of VAS 21. So, according to these standards, a complete enterprise financial reporting system requires 4 interconnected dials. First, you've got B01, the balance sheet, which gives you the financial position. Then B02, the income statement, which tracks performance. B03 is the cash flow statement, showing cash in and out. And finally, B09, the notes to the financial statements. You absolutely have to monitor all 4 to get a true picture of a company's health. And as you'll see, they wire together beautifully. Moving right along to Section 2, Snapshot versus Video. This is our core comparison between the balance sheet and the income statement. All right, let's clear up the biggest conceptual hurdle that always seems to trip up accounting students. It's all about how these reports treat time. Think of the balance sheet as a photograph. It's a snapshot of a company's assets and liabilities at one exact point in time, say, exactly at midnight on December 31st. The income statement, on the other hand, is a video. It records the flow of revenue, expenses, and profit over an entire accounting period, like a full year. So remember, one freezes time, the other records over time. Now that snapshot, the balance sheet, is governed by one ironclad rule, the basic accounting equation. Assets must equal liabilities plus equity. This equation is always, always balanced. Actually, scratch that. It has to be balanced. Whether you're buying inventory, taking out a loan, or paying off debt, the principle of double-entry bookkeeping ensures this equilibrium never breaks. Let's actually see this equation in the wild using some data from Hobbein Food Co. Looking at the bottom line, their total assets sit at 6,000 million VND, and their total equity and liabilities perfectly match that at 6,000 million. But what's really key here for your own analytical skills is their equity ratio. With equity at 2,800 out of that 6,000, they're rocking a healthy 46.7% equity ratio. That indicates really solid level of financial independence. But let's see what happens when we switch over to our video recording, the income statement. While reviewing Hobbein's performance over the year, there's one number flashing like a big red warning light on our dashboard. 320 million VND in financial expenses. This is a metric management needs to monitor constantly. It shows you exactly how the costs of doing business are just ticking away over time. And tracking that video over the period reveals the true efficiency of the business. See, Hobbein starts out with a pretty solid gross profit margin of 24.9%. But once you factor in those financial expenses we just talked about, along with the everyday selling and administrative costs, well, that margin shrinks down to an 11% net profit margin at the bottom line. It really puts things into perspective, doesn't it? Which perfectly tees up Section 3, the profit-cash paradox. We'll be looking at case study 01, Company ABC. Okay, picture this. A company reports a net profit after tax of 2 billion VND on their income statement. Huge win, right? But they have absolutely zero cash in the bank to pay their employees' salaries this month. Seriously, how is that even possible? You're highly profitable on paper, but your employees are practically rioting in the lobby. This right here is the fundamental paradox that completely baffles so many students and investors. To solve that mystery, we head to Section 4, following the cash flow, and decoding Statement B03.
So, the cash flow statement is your ultimate truth teller here. Why? Because it tracks actual, cold, hard money. It breaks down exactly where the cash goes into three distinct buckets. Number one, operating activities. That's cash from your daily business. Number two, investing activities, like buying or selling fixed assets. And number three, financing activities covering loans, bonds, and equity. So if a company has $2 billion in profit but no cash, the operating section will likely show you that the cash is tied up somewhere else, maybe rotting away in a warehouse full of unsold inventory or stuck with slow-paying customers.
Let's pull up Hoabin's B03 report to see what a beautifully healthy flow looks like. Look at this! They generated a fantastic positive cash flow of 1,424 million VND straight from their operating activities. Because their core daily business is actively generating cash, they can easily fund their investing activities, expanding by spending 750 million, and their financing activities, like paying down debt or issuing dividends for 500 million. And after all that, they still walk away with a healthy 500 million in closing cash. That is the dream scenario.
All right, final stop, Section 5, Reading the Fine Print, which covers the notes to the financial statements, or B09. Think of the notes as the instruction manual for your dashboard. They're an absolutely inseparable component that explains and supplements everything else. For example, if you're wondering what specific depreciation method the company uses, or if there was a massive post-reporting event, like say they signed a contract for a 2 billion VND equipment purchase on January 5th, right after the December 31st snapshot was taken, you are only going to find that context right here in the B09 notes. And believe me, nobody likes a multi-billion-dollar surprise right after posing for a photograph. And this is where the whole dashboard metaphor beautifully comes full circle. It's like a giant puzzle. These four statements are deeply, inextricably connected. The net profit from your video, the BO2 income statement, flows directly into and increases the equity on your BO1 balance sheet snapshot. The closing cash from your BO3 cash flow statement, that will perfectly match the cash line item at the very top of your balance sheet. And the BO9 notes just sit right underneath, explaining the mechanics of the whole shebang. Well, let's wrap this explainer up with a quick test of your newly sharpened analytical skills. Imagine you're looking at a balance sheet. Total assets sit at 10 billion. Total liabilities are 8 billion. That means their equity is only 2 billion, leaving them with an 80% debt ratio. So, if you were a bank looking at this dashboard, would you extend them additional credit? I'll leave you to ponder that capital structure and just how financially independent they really are. Keep reading those dials, stay curious, and I'll see you in the next explainer.